Today I'm going to make a start with year-end adjustments. I'm going to need to do several videos on this topic due to the number of adjustments that I need to explain. But today I'm just going to cover depreciation. Any fixed asset that you purchase, like vehicles and equipment, as they get used, they're going to decrease in value. So as they get used due to wear and tear, the value is going to decrease. And that decrease in value we refer to as depreciation. Now later on this year, you're going to do something called a balance sheet. And the purpose of a balance sheet is to show the correct value of your assets, liabilities, and owner's equity. So if a fixed asset has depreciated, we need to take that into account when doing our balance sheet so we can show the correct value of those fixed assets. So that is why it is necessary to make an adjustment for depreciation. There are two methods of calculating depreciation. The first method is called fixed installment method or cost price method. That is simply you take the cost price and you multiply by the percentage. That would give you the same amount of depreciation every year, which is why it's called fixed installment method, the same amount of depreciation every year on any one particular asset. The second method is called diminishing balance method. For diminishing balance method, you take the cost price and you subtract accumulated depreciation and then you multiply by the percentage. Remember, the accumulated depreciation will refer to all depreciation on the assets in previous years. And that account is a negative asset, so it will always have a credit balance. Okay, if you have a look at this example now, they give you a pre-adjustment trial balance. Pre-adjustment means it's before you've made any adjustments. So you're given a vehicles and equipment total, those are your cost prices, and then you're given accumulated depreciation on each asset. Take note that those balances would be on the 1st of March because you only work out depreciation once you get to the end of the financial year. If you sell an asset during the year, then you will work out depreciation during the year, but that is for grade 11, so it's not a grade 10 topic. So that will be the last time we worked out depreciation, all the depreciation on vehicles added together, as well as on equipment. And then they tell you the adjustment to provide for depreciation on equipment at 10% per annum cost price and vehicles 10% diminished balance method. Start off by doing your calculations. So equipment, it's cost price. So you take the cost price of equipment here, the 15,000, and you multiply it by 10% and you get 1,500. With vehicles, it's diminished balance method. So you take the cost price of the vehicle, 80,000, and you subtract the accumulated depreciation of 8,000, and then you multiply it by 10%, and that gives you 7,200. Now, two ledger accounts are going to be affected here. The one is depreciation. Depreciation is an expense, and it's only going to contain this year's depreciation. Accumulated depreciation is a negative asset, and that account will contain all the depreciation on any asset up to the date of the current financial year. So if you have a look here, you'll notice here I have debited depreciation. That is because it's an expense that's increasing, and I credit accumulated depreciation because your negative assets are increasing. And you can see how that looks in the ledger. Accumulated depreciation, I've told you a couple of times now, is a negative asset, so it's minus plus, so the balance comes on the credit side, the plus side. If you look at what they tell you to do here, they tell you to credit it. So you put that 1,500 on the credit side, and the details, you look at what's debited, that will be depreciation. Can you see our accumulated depreciation has now increased because we provided for another year's depreciation? The same thing is going to happen with vehicles. You start off with the balance and the trial balance, and then you're going to credit it with another 7,200, which will increase your accumulated depreciation. And then in your nominal section, your depreciation, we're going to debit that, but we need to have two contra accounts, two other accounts. So you need to split up here accumulated depreciation of equipment and accumulated depreciation on vehicles. Remember, I did closing transfers in a previous video. Once you get to the end of adjustments, that's when you do closing transfers. So can you see how we are going to transfer to profit and loss a new account now called depreciation. It's very important that you understand that this amount here is for this year's fixed assets depreciation only. Just one last thing before I finish. There are some assets that appreciate in value, particularly your land and buildings. They go up in value over time most of the time. We don't make any accounting entries for appreciation. The reason for that is because that is a subjective value. You can't just say, well, my assets are worth 2 million rand. You don't know that unless you actually get an offer to purchase your assets for that amount of money. So to prevent manipulation of financial results, no appreciation is recorded. So no business is allowed to record appreciation in the value of assets. Okay, in the next video, I'm going to make a start on additional adjustments. For now though, guys, that's it. Thank you.